Investors are often familiar with a trading strategy called sell in May, go away, which involves selling stock holdings in May, stepping out of the market during the volatile summer months, and then buying back into those holdings in September. Now, while this may have worked at some point in history, if you followed this strategy for the past 6 years, you have been wrong for 5 out of 6 years, which suggests that this strategy may be completely dead going forward. So in the video today, we're going to be actually looking at the return data for the S&P 500 from June until August from 2020 all the way to 2026 to prove this point. Hello everyone, my name is Michael Ruger. I'm the managing partner of Greenbush Financial Group, and let's take a look at the return data. So here's a chart of the S&P 500 index return June through August through the years 2020 all the way through 2025. So the way you read this chart is in 2020, in June, the rate of return of the S&P 500 was 2.02%, and you can see the returns for July and August. So if you did sell in May and go away in 2020, you missed out on a 13.79% rate of return. And if you remember, in 2020, that was COVID, so there were plenty of reasons why you may not have wanted to have been in the market during the summer months, and you would have been very, very wrong. In 2021, if you enacted this strategy, you missed out on a 6.75% rate of return over the summer months. 2022 would have been the only year in the last 6 years that this strategy worked, where the market was down 3.37% for those summer months. 2023, the summer months produced a 7.81% rate of return. 2024, a 6.02% rate of return. In 2025, this year, it once again produced a 10.44% rate of return for June through August in the S&P 500. All said and done, if you followed the sell in May and go away strategy for all 6 years, you missed on an average annual return of 6.91% over the last 6 years, which is massive. While it can be tempting for investors to use these market timing strategies like sell in May, go away, September is historically a bad month for the markets, or Santa Claus rallies at the end of the year, when you look at the hard data of what has actually happened in the markets for the past few years, they might realize that just timing the market is just causing them significant investment returns over the long term. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.